Good morning, everyone. Hope you guys are staying safe and keeping safe from this COVID-19. With this, I would like to start our webinar session today on liquidity risk and ILAP, managing liquidity under stress. So today, before we start, I would like to thank Remand Risk Management Association of Nigeria for partnering with us to host this webinar. And I would also like to thank our speakers, Mr. B and Mr. Satya. Before we start, I would like to also bring in some introduction for our panelists today. Our speaker today is Mr. B. Olagbami. Mr. B has 25 years of banking experience with over 21 years of experience working specifically in risk management. His most recent work experience is as Chief Credit Officer at Union Bank, Nigeria. Prior to this, B has always been as a Chief Risk Officer with Fidelity Bank, Ghana. He was Chief Risk and Compliance Officer at Keystone Bank. And he's also worked briefly as Group Market Risk Manager with Axis Bank PLC in his early years. Prior to which, he held various positions in Citigroup, including Country Risk Manager for Central Africa, Risk Manager for Egypt, and other portfolios during his stint with the bank Citigroup. B holds BSc and MSc in architecture from Obafemi Awolowo University, and also is an MBA from IESE, University of Navarra, Spain. Our second panelist today is Mr. Satya Vemiredi. He's Director, Asset Liability Management and Balance Sheet Analytics at Aptiva. Satya is an ELM and market risk professional with more than 12 years of experience in banking, risk advisory, and IT areas with exposure to international and GCC banks. With Aptiva, he heads our ELM advisory practice, and drives numerous projects on IRBB, ILAP, FTP, and behavioral modeling across GCC, Africa, and Europe and Americas. Before that, he's also having an extensive risk consulting experience with EY as an financial risk manager, and has been advising banks, financial institutions, and regulators across risk areas of ALM, FTP, Basel, Accords, and market risk. With this, I would like to invite our first panelist, Mr. Satya, to start his part of the session. And followed with that would be the session from Mr. B. Satya, over to you, please.
Thanks, Pratik. Good morning, everyone. So let's just look, quickly at the agenda of the session today. At least, for the part that I'll be speaking. So I'll be looking at the various aspects and the best practices followed in liquidity risk management, and how COVID-19 has changed certain views of the management in managing liquidity, and how banks need to adopt in this dynamic environment while they manage their liquidity. And then after that, there'll be a brief Q&A session for this part of the presentation, and then I'll hand it over to Mr. B, where he will take the panel, the session through the impact, specifically focusing on Nigeria and Africa regions. So with that, let me quickly talk to you about certain key themes that are currently prevalent in the market. The COVID-19 crisis, it has definitely brought a paradigm shift in literally everything, in terms of our work culture, in terms of how companies operate, and in terms of how the global economies are operating. From a primarily risk management perspective, of course, again, there has been a significant impact. Pre-COVID, largely risk management has played a more reactive and a static approach, where most of the risk management was driven by regulatory requirements, such as the Pillar 1 requirements in this case, from a liquidity perspective, LCR, NSFR, and from a capital risk, perspective, the capital adequacy ratios, so on and so forth. While there has been push from the regulators towards more pillar two approach, where there could be more dynamic approaches, more simulation based approach, more stress testing based approaches, but that has been slow, across geographies. Certain advanced jurisdictions have taken up certain dynamic analysis and stress test, integrated stress testing, but it is still yet to catch up. But we think that post COVID, um, regulators across regions will look to a more dynamic approach towards managing risks and measuring risks within the banking system. It will be primarily driven by scenario based analysis, where they test impact, deriving from shocks to the economy, like what we just saw during the COVID-19 pandemic, and various aspects that would be covered, the impact of the environment, the business risk, as well as certain advanced approaches that could be used in risk management. And all of this is leading to a more static or passive risk sustenance to a more resilience focused approach, where the idea is that, fine, I mean, the current profile of the banks in terms of the risk on their portfolios is being managed, and there are certain monitoring frameworks available to monitor credit risk, liquidity, interest rate risk, so on and so forth. But what regulators going forward will be looking for is resilience. That means it's not enough to just look at your current portfolio or the historical performance of the portfolio. You need to be able to prepare for uncertain futures, uncertain futures like COVID-19. And there is prognosis that COVID-19 will not be the last pandemic. And there are many more, such events, despite how, countries may prepare. There is increasing scope for such pandemics to occur, given the growing interconnectedness and transformation of information and people across geographies. So with that, uh, let's look at how what are the key challenges in front of the senior management currently at banks, from primarily focusing from a liquidity perspective. Within most banks, the asset liability committee, or ALCO, is the primary management committee that looks at asset liability management and balance sheet management. So at a very broad level, there are three key focus areas. Uh, from risk management perspective, a strategic planning in terms of the future growth, the projections, the budgeting, what kind of balance sheet structure the bank wants to adopt, the performance measurement, and how that performance measurement drives in terms of further allocations. And then finally, the funding and capital management aspect of managing the balance sheet. So ALCO usually, comprises of finance, risk, treasury, chaired by either the CFO or CEO. And there are certain regulatory directions, regarding the composition of ALCO and how frequently they need to meet and what kind of analysis that they need to look at and what kind of metrics they need to monitor on a regular basis. And given that, and given their remit to look at liquidity risk, interest rate risk, FX risk on structural FX risk on the banking book, performance measurement. If I were to summarize, the key challenges from a risk perspective, it would be the primary challenge would be to ponder on how can they ensure that all material risks on the balance sheet are being measured and monitored accurately, and whether the bank has taken into account unforeseen events and certainly events like COVID-19 in their preparedness. For example, there could be a number of assumptions that go into your risk management framework in terms of how the cross linkages between various risks work. How a shock in liquidity can flow into credit risk, or how economic downturn can eventually lead to a funding, or from a increase the funding risk or liquidity risk on the balance sheet? Are such linkages tested enough? Is there any back testing, or will the linkages hold, or the assumptions hold, in extreme situations that the globe just witnessed? And are the systems and capabilities in place to accurately and frequently report on such positions, or measurement of risk positions on the balance sheet? And what kind of investments do they need to do in terms of personnel and systems going forward, to be able to perform a number of dynamic analysis to ensure that the risk is measured more accurately, and the aspect of resilience is brought into the risk management framework? And secondly, from a strategic planning perspective, of course, the primary objective of any strategic planning exercise is to enhance value. By enhancing value, I mean, either it could be drive increase in the valuation of the organization, or in the short term, how can you ensure or protect that your net interest margin keeps growing, or at least it does not witness a shock? Because as you've seen across geographies, there's been a lot of volatility in the interest rates, and a very low interest rate environment is currently prevailing. That may change very soon, as various geographies announce large stimulus packages which may drive inflation, and again you may see interest rates going up. And banks need to be very conscious of such decisions that are being made across the globe, in large economies like the US, the EU, in terms of how it impacts interest rate changes, and what kind of positioning do they need to take in terms of their balance sheet structures to ensure that they are hedged or able to take advantage of such changes. And while planning the growth, they also need to be cognizant that a pandemic like COVID-19, if it occurs again, what kind of impact will it have on their plans? Will they be able to achieve the growth expected? If not, what kind of impact would it have on their profitability? And would their risk position still continue to be within the board approved risk appetite limits? So these are some questions ALCO would be looking at from a strategic planning perspective. And finally, from a funding and capital management perspective, again, the key question is, today, as the bank stands, the level of liquidity and the maturity profile of its funding, is it sufficient to tide over another such pandemic? Or what kind of hidden risks exist on the balance sheet? And how do we diversify the sources of funding? From a contingency perspective, what are the options of funding for the bank in times of contingency? Are they operationally ready to take advantage of their contingency funding plans? And how do they structure their capital issuances or medium term note issuances going forward, given the expected changes in interest rates and the overall economy in the next 3 to 5 years, that is the medium term? So these are some key challenges in front of the senior management today. And the question is, are banks today in a position to quickly assess the impact and support the analytical requirements required to accurately answer the questions posed on this particular slide? Now, with that context, let us just take one step back and just try to understand what it is that we are trying to measure, and what kind of frameworks can we have in place to adequately measure, monitor, and manage on a regular basis. As Basel defines, liquidity essentially is the ability of the bank to fund increases in its assets to meet its growth, and also meet all obligations, any withdrawals, cash outflows as they come due, without incurring unacceptable losses. The unacceptable losses part comes where they may have to sell off certain investments, or they may have to pay higher price to new deposits, which may lead to impact on their profitability. And essentially, uh, there are two types of liquidity. One, the short-term liquidity, which is essentially the high-quality liquid asset holding, and the structural liquidity, which is essentially the stable funding profile, whether uh, the growth expected from on the asset side, can it be met with a stable funding source that can stay with the bank over a long period of time without running off in times of stress. So these are the two core elements of liquidity. And short-term liquidity is usually captured through cash, reserve holdings with the regulator, and liquid securities, which are usually defined as part of your LCR HQLA. And structural liquidity, essentially, the core component would be capital, the core portion of your customer deposits and other long-term deposits and issuances that qualify for stable funds. And when and as regulators try to bring in a more dynamic approach to this uh, to the risk management practice, uh, we need to understand so one of the key regulation that is being introduced in a number of jurisdictions and has been around for a few years in advanced jurisdictions, called the internal liquidity adequacy assessment, which is a parallel to the ICAP, or the internal capital adequacy assessment, that has been there quite for some time now. Now, on the liquidity side, what are some key aspects that all banks need to get right to ensure that liquidity risk is adequately measured and monitored? From a strategic planning perspective, liquidity and funding need to be a core component of strategic planning, in terms of where the growth is coming from, in terms of how the projected balance sheet looks like, and whether the current liquidity will be sufficient. So at the very highest level, at the senior management level, liquidity needs to be visible in the analysis, and board and senior management need to be cognizant of liquidity as a concept. And then coming to the roles and responsibilities of who is responsible for risk identification, risk measurement, and developing the appropriate models, setting up the policies and the risk limit or risk appetite limit definitions, and who will be responsible for monitoring or adherence to those frameworks, and finally, who will be responsible for mitigating or taking actions to mitigate those risks. So there needs to be a clear definition within the organization to identify specific roles or the full life cycle of a particular risk. And then when we look specifically at liquidity assessment, which is nothing but what is the current state of liquidity, current availability of high quality liquid assets. So there are a number of pillar 1 ratios from Basel that help banks easily assess their liquidity readiness or sufficiency, which is liquidity coverage ratio and net stable funding ratio. In addition, regulators often prescribe numerous other related ratios, for loans to deposit ratio or maturity mismatches, funding concentration. So there are a number of metrics that help assess banks in terms of whether their current liquidity is sufficient or not. Add to that you know analysis that also will be able that should be able to tell you whether, given the projected growth in the short to medium term, will my liquidity profile still be within a healthy level prescribed in the risk appetite. So that is the dynamic analysis part that needs to be brought in along with the static pillar one based approach. And that is where the stress testing element also comes in. In terms of stress testing, banks need to have a strong framework in terms of defining various scenarios, both hypothetical and historical, and yet plausible, and have a granular approach to stress testing rather than a high level assumption driven assumption analysis. We will see this aspect in a bit of detail in a few slides. And setting the appetite and limits, I mean, driving from the liquidity assessment, both current, historical, and future, and then stress testing, which is essentially again assessing the sufficiency when applied with the stress. Deriving from these experiences and analysis, the appetite and limit setting exercise should be carried on so that bank is acutely aware of what are the thresholds that it can really manage, beyond which it will be difficult to manage without incurring costs, both in normal times as well as stress conditions. So there needs to be limits clearly defined under both liquid or normal operating times as well as stress times. All this analysis then further drives into the contingency funding plan. So once the bank understands what is its tolerance, what is its capability to respond in times of stress, based on that a contingency funding plan should be drawn, so that actions that are plausible, that can be taken during times of stress, need to be documented, and the practicality or operational capability of which should be tested on a regular basis. So each of these elements is a critical aspect, and we'll cover these in subsequent slides. And finally, the optimization. Given this extensive analysis, then it will result in a realignment of the nature, the diversification of the funding, the maturity composition of the funding, as well as the level of liquidity holding. So this, in short, is a life cycle of liquidity management, and this is where ILAP, or the internal liquidity adequacy plan, comes into picture. Essentially, ILAP is a document that summarizes the state of the bank with respect to the liquidity life cycle that we just saw. Some key elements of ILAP start from governance in terms of adequacy of the org structure, the role definitions, the delegation of authorities, specifically from a funding perspective, whether which level of whether the ALM does, the treasurer, the head of funding. So what level of authorities do they have to approve funding pricing, from a funding perspective? And also from an investment perspective, who has the authority to take decisions on behalf of ALCO to increase or decrease holdings in liquid securities. And then we have talked about policies and procedures and adequacy of monitoring and control frameworks. And then we've also looked at the funding strategy. Some key elements that banks need to take into account when developing their funding strategy is to have a strong review of the economic outlook and operating environment for the projected period, and incorporate all strategic initiatives, not just the growth on the balance sheet, but there could be a number of strategic initiatives which could need additional funding, like acquisitions or opening new branches, for example. So these kind of, or investing in new digital technologies. So these kind of initiatives also need to be taken into account while drawing the funding strategy. And of course, a prior year review will give a good understanding of the capabilities of the bank in terms of whether the growth expected on a monthly basis is realistic, and the operational readiness of the bank can actually support such a growth. And then finally, coming to the actual growth, and then the sources of funding that could support that particular growth. Liquidity assessment we've just talked about. So again, I mean, just to summarize, these are some key elements that regulators require banks to capture and document as part of their ILAP exercise and submit to the report, the regulator. Again, risk appetite, a granular risk appetite across various risk categories, both pillar 1 and pillar 2. We'll also see what is pillar 2. And again, having limits during both for normal times as well as stress situations. And then a robust stress testing framework, and pillar 2 risks, which will include your maturity mismatches, which are usually not part of LCR and SFR, intraday liquidity, and the risks posed due to holding of intraday collateral, or a lower level of intraday collateral, the adequacy of systems and infrastructure, awareness of policies and procedures, among the staff of the bank, liquidity transfer pricing, intra-group transfer of liquidity. So a number of such aspects, which are usually not covered as part of the pillar 1, are included in the pillar 2 risk and are expected to be captured within the stress testing exercise and the overall ILAP document. And then a brief overview of the contingency funding plan and how the bank plans to handle any significant cash outflows or funding requirements during stress situations, and a report on how frequently they have been testing their operational readiness of their contingency funding plan. And finally, a note on the adoption of ILAP within the organization. So it is not, they don't want banks to make this annual exercise where a report comes out and then nothing happens. They want clear indication that this particular document is being used for internal consumption in terms of decision making. They need to see evidence that there has been adequate discussion among the senior management in preparing such a review of liquidity risk within the bank. They need to see sufficient evidence of challenge to all the assumptions and methodologies that have gone into developing these models. So a number of models may be involved, in coming to this stage, and how the outcomes in terms of the ability of the bank to sustain certain levels of stress. What are the breaking points? What are the assumptions that may need to be looked at? How these aspects are taken into cognizance during the strategic planning exercise. So the evidence for such discussions also need to be documented as part of ILAP. And so let's quickly look at a few key aspects in a second level detail. So first of all, when we talk about assessing liquidity, we start, the fundamental view of liquidity analysis in a bank starts with structural mismatch reports, where you look at periodic buckets and what kind of shortfall exists in each bucket, and whether the bank is in a position to roll over their existing deposits or book new deposits to cover those shortfalls, and certain simulation or sensitivity analysis in terms of what will happen if such structural mismatches increase by certain percentages. And then, so structural mismatches usually mostly give contractual profile of how the cash flows are going to look like. But for one thing, they give the view of only the current positions on balance sheet. The second aspect is they only consider contractual. So we need to bring in the behavioral element into the analysis. So there are a number of products offered by banks which don't conform to contractual schedules which are pre-planned. For example, prepayment, drawdown on non-maturing deposits, or early breakage of term deposits, or rollover of funding lines. So a number of such aspects need to be adequately covered to get a better view of how these behaviors change during stress. And of course, from a regulatory perspective, there are LCR and NSFR. In addition to those ratios, banks may also adopt certain sensitivity analysis of the various assumptions given while computing those LCR and NSFR ratios. For example, did you assume 5% runoff on your retail, stable funding? What would happen if you increased that to 10%? Or from a wholesale perspective, what will happen if the runoff rate, because These assumptions have been benchmarked to an exercise that involved a large number of banks from across the globe. These may not be very accurate or applicable to the current scenario or the jurisdiction. So it makes sense to get a realistic understanding of what those weightages look like, and then perform certain sensitivity analysis to look whether there is hidden risks on the balance sheet. And finally, the dynamic planning, which we again talked about. So far we've only talked from a static perspective, whether it is structural mismatch, behavioral, or regulatory. It is current book. But dynamic planning should take into account what will happen when you put layer on top new business growth for the coming month, coming year, coming quarter, whatever the time horizon that you're looking at. So we've included certain elements of how behavioral modeling can be done. So in interest of time, I know we will share these slides, but there's something for reference in terms of what aspects that banks can look at while performing behavioral analysis. For example, how behavioral analysis, when doing behavioral analysis, it's not that the entire portfolio works in the same way. So you need to first of all identify the homogeneous cohorts within your portfolios. For example, your current accounts, not all current accounts operate the same way. So you need to classify them by the end use, for example, the product type or the size of the accounts, the rate paid on their accounts. So accounts where a high rate is paid will definitely behave differently compared to accounts where no or very low rate is paid. So a number of such factors can be considered while developing. Probably this could be a topic for a separate session. And coming to the liquidity risk analysis. So from a stress perspective, we first need to understand what are the key risks that can happen at the time of a shock event that happens today in the market. So what are the things that can happen in the next 1 week or next 1 month? The first aspect is your assets, the behavior of assets. One element is that there could be increased delinquencies. That means there could be reduced cash inflows. So this is one aspect that needs to be considered. The second is, so these are essentially the key pillar 2 risks, or the elements of the risk factors underlying from a liquidity perspective that ILAP exercise wants you to cover during the stress testing exercise. So in terms of your non-liquid assets, which are primarily your loans. So the behavior in that is whether there'll be additional drawdowns or whether there'll be delinquencies. And from a liability side, retail funding risk, wholesale funding risk. From a retail perspective, whether there'll be higher level of runoffs. From a wholesale perspective, there would be, the markets would dry up. Or for example, there would be the prices would spike, the pricing spreads that you pay would spike. Or whether there would be lower level of rollover. You would not be able to roll over, a number of deposits which you have historically been able to. And from off-balance sheet perspective, whether there will be increased devolvement in contingent liabilities like commitments, LCs, LGs, and increased drawdown on undrawn credit and liquid facilities. From a pricing risk, we have just talked about it. So bank may have to pay, double or triple the spreads that it usually pays to book new deposits during stress. And from a marketable assets or market volatility risk, we're talking about the valuation of a number of instruments that were considered liquid, either from a liquidation perspective or from a repo perspective. There could be increased haircuts on liquidation or raising funding through the repo channel. And similarly, concentration risk. So if you have exposure to a large exposure to single names, that could be a big source of risk during stress when that person decides to withdraw his deposit or his or her deposit, or if it's an institution. And similarly, in terms of tenors, tenor concentration risk, whether most of your deposits are concentrated in the short-term maturities. what will happen if that proportion increase? What will happen if the deposit distribution gets more evened out? And the transferability risk and market access risk. So transferability is essentially whether you'll be able to quickly bring back liquidity available in one of your subsidiaries in a different jurisdiction, or whether you would have to step in to fund additional liquidity requirements of a subsidiary. And then the market access risk. So for any number of reasons, disruption, cyber attacks, or system failure, internal system failure, if the bank is unable to access markets, how long will it be able to sustain? So these are a number of risk factors that regulators want banks to assess when performing their liquidity stress testing exercise. So we have developed a risk factor based approach that can help banks incorporate all these factors, design their stress scenarios as per their time requirements, severity requirements, and then assess over a period of time how what kind of impact it can have on key metrics like LCR, NSFR, for example, and how management actions can be incorporated, and see how those management actions or contingency actions can recover these ratios. And a number of additional items like what kind of cash flows can be expected during stress, how the balance sheet is going to contract or expand during the stress period. So a number of such analytics, as Aptiva, we have helped a number of banks develop these frameworks. And I think, from interest of time, I would like to take any, questions. So essentially, I mean, this concludes my side of the presentation. So I've just wanted to highlight the key aspects of contingency funding plan and the readiness of banks to have a strong contingency funding plan in place. So,
thank you, Satya. I think there are two questions that we have for you right now. One is Mr. Francis Taki is asking that any strategic plan in dealing with this high concentration on deposits on few depositor, example, great less than 50% of total deposits.
Sorry, I.
You can also read the questions in the Q&A section.
Yes. Now, I mean, from a funding perspective, see, from a liquidity perspective, it is easy to take short-term decisions to quickly change the composition of your investment book, so on and so forth. But any decision on the funding side is essentially strategic in nature. That means it will take time, to operationalize. And there is no short answer to how a bank could reduce dependence on a few depositors. Obviously, building the new relationships in terms of funding, continuously maintaining and being in touch with potential source of funding, or exploring new opportunities like institutional investors in foreign countries. Now there are a number of opportunities given the low interest rate environment prevailing in the number of advanced economies. They are looking for safe and high growth assets in foreign jurisdictions. So there are a number of such funds available, that can be brought in. And issuance of, for example, you could relook at what is the structure of your funding, composition of balance sheet in terms of what is the customer funding and what is your borrowings in the market. So you could probably increase borrowings in the market to compensate for that. So they're not just one or two, or you could focus, bring in more schemes to attract CASA, current and savings accounts, and bring in payroll accounts. So there are a number of strategic actions that banks can take in this aspect. I think Prateek, let's give the forum to Mr. B, and then we can come back to this at the end of the session.
Sure. Yeah. Thank you so much, Satya. I think with this, I'll request Mr. B if he would like to share his screen for the presentation on his part of the session, please.
Prateek, I'm sorry. And thanks, Satya, for a very exhaustive and very clear presentation. I had told my colleagues at Riemann that I will not be making any
Oh,
presentation.
sure.
The reason being that I was sure that much of what I would have in a presentation would be covered by Satya, and I was quite correct. So even the presentation that I had put together will only be a repetition of much of what he has said. And that was why I'm looking at just speaking to much of what he has said as it relates mainly to the environment under which we operate. The whole world now operates in a global environment. It's a global economy, but we still have nuances that that are more peculiar to certain economies more so than others. And so, whilst thanking Satya for the many insights that he has given, I would focus a little more on how risk managers, market risk managers, liquidity risk managers, and risk managers in general cope with the challenges that the Nigeria business environment portends and presents, especially to banks and the businesses and the various areas of the economy that we support. In my view, over time, the key issues that face us as banks in Nigeria, especially from a liquidity perspective, hovers around the issue of the availability of funds in itself, the cost thereof, and the quantum. I think in one of the questions that was posted to you, they were talking about concentrations. Indeed, funding and the concentration of funding sources is a continuous challenge that we face as bankers in Nigeria, and the attendant issue to that is the cost of the funds. So you always tend to, as financial institutions, to want to diversify your funding sources, maybe get cheap CASA as opposed to term funding. But the reality is that depending on your risk appetite, depending on your target market as a bank, depending on um, your own internal and external strategies and competition, sometimes you do have to live with the kind of funding that presents itself to you. But the impression, the preference is to go for cheap funds in a more diversified manner. We also then want to match that with your maturity. So you find that one of the major challenges again that we have is that funds are typically short term, whilst what you have to fund are typically longer term. So you have an inherent mismatch in the business that you do from a liquidity perspective. You typically have to have short-term funds supporting longer-term assets, which brings the issue of gapping solidly into your focus. So you have to continue to monitor your gaps both from an amount and a tenor perspective, and that really is one of the most critical balance that the financial institution must maintain from a liquidity perspective. Again, that then spills over to the issue around contractual and behavioral maturities, and that in itself is a challenge because contractual doesn't always happen as contracted. You made the point about current accounts. It has zero tenor, but we all know that it doesn't happen that way. And so you tend to have current accounts more stable from a behavioral perspective vis-a-vis a contractual perspective. But at the same time, you do not want to overly rest on your oars in that regard because, quite frankly, a contract is a contract. On the day that the contract is to be enforced, are you as a financial institution able and ready to meet those obligations. And then there are the foreign currency environment is a major issue in the Nigerian business environment. A significant portion of our business has to be done in foreign currency because we do import quite a bit. And over time, depending on regulatory, overarching regulations, as well as economic performance, you find fluctuations in FX supply, FX pricing, FX availability, and that in itself affects our the way we do our business. And of course, there are the major unknown risks, where a typical example, obviously, is the pandemic. Is it done? Is it not done? It's been with us for the better part of 18 months now, and we're still grappling with certain aspects and certain effects thereof. So what do we do? Is there going to be another major issue of this nature in the next 5 years, in the next 10 years, in the next 5 months? You never really fully know, but as risk managers, again, and as financial industry participants, we have to have a sense of all of these things as it has affected us in the past and how it will affect us in the future. So in my view, this captures the entire gamut of the issues that we face. And these are by no means small issues. They are quite major. We know that liquidity is the lifeblood of the financial system. It's the lifeblood of the bank. And if a bank fails on liquidity, it can end its license even within a couple of hours, not even days. So this is the pulse, and these are the things that we grapple with. And it is our duty and responsibility as risk managers and risk participants, or risk practitioners, that we put the financial institution and the financial system in a position where we can manage all of these issues and all of these challenges in a manner that guarantees consistency and resilience in our operations and in our profitability, both in the current position and in the future. I guess that really is the reason why we are having this conversation. That is the reason why we have conversations like this, that in spite of all of the things that we see, in spite of all of the challenges that face us, how do we navigate this turbulence? How do we navigate these stormy waters to get our institutions and our economies to a safer position where at least we can reach the shore safely and profitably. And it's on this basis and for these reasons that, again, these key objectives are the reason why essentially we do what we do from a liquidity management perspective. And you spoke at length to all of the tools and all of the systems that are in place to ensure that we continue to manage liquidity adequately and appropriately. The liquidity management cycle is not new, but it's evolving. And I do take your point that, again, we've moved from static risk management to what we call dynamic risk management. We've moved from analog review, past review-based risk management to more digital, online, and forward-looking risk management. So what that means is that more than ever before, scenario analysis must be at the center of what we do. We as each institution, especially driven by its own determined appetite, must have a view, a very clear view of how it wants to navigate going into the future. So the scenario planning, the stress testing must be very vigorous, and it must be continuous, especially in a situation where we are now. If we were, this is not the time for annual stress testing or annual review of performance. It has to be regular, it has to be continuous. We need all of the AIs that we can, and robotics that we can put in place, all of the digital systems that can support us to ensure that we are able on a continuous basis to identify and follow through on our touch points. We need very robust stress testing. We need to have a clear idea of and that was why I tried to state out what, in my view, the key issues are, because that will determine the parameters and the stress levels of our stress testing, so that we can determine the various scenarios that may play out and have our different defenses and alternative actions to, or evasive actions, as the case may be, to ensure that we mitigate whatever we see ahead. Which, so it's in that understanding that you can put in place other tools like your strategic tools, like your contingency funding plan. Again, we have to be very careful in our various environments where we work, not to just pick up last year's contingency plan, update the dates, update this and that, and present for approval. that would be a very dangerous thing to do. We have to ensure that all of these documents we need, if we've forgotten what they mean or what they're supposed to be for, this is a time for a reawakening, a revival, if I may use that term, to understand the importance of all of these documents. Although they are not documents, they are living testaments of what we intend to do. And we should be ready to test the contingency funding plans. We've created those scenarios in isolation just to test the availability, the suitability, the robustness of the various contingency plans that we had put in place. Again, another critical document is our risk appetite. Risk appetite from a funding and liquidity perspective must be consistent with our risk appetite for all other risks as well. The risk of asset creation from a lending perspective, the risk of the nature and even all the way to recruitment, to operations, to processes. There has to be a consistency. If you want to go the high risk route, you need to ensure that all of your processes, all of your other areas of your business support the high risk appetite that you develop for yourself. And if it's a medium risk appetite, let's also ensure that we have the right tools and the right policies, standards, and principles that support that. I need to say at this point that it is very, very common for financial institutions to say risk appetite is medium. Unfortunately, again, we need to drill down to what we mean by medium. Medium has always been the safe place where everybody packs into, and meanwhile we say we are medium, but actually we do a lot of things that are actually high risk. We need to point the spotlight internally into ourselves to really define what we mean by medium, define those things that we want to do and not do, and not find ourselves scampering when things get a bit testy. The next point flowed from that is our ability to set the right limits. Now, there are two aspects to this. It's not just, we first of all need to know the parameters that are critical to us before we set the limits. Again, we need to ensure that we do not fall into that trap of just picking last year's or last quarter's parameters and then tick up a bit or down and raise it a bit or lower it a bit. The environment has shown us that things change too quickly. Some parameters are no longer relevant. Let's shove them out. There are others that are now relevant. Let's bring them in. So that's another critical area, in my view, from a strategic perspective, in ensuring that we have the robust liquidity management process in place. Now, apart from strategic, longer term determined actions or determined processes and principles that we have in place, there are also those that I consider maybe more tactical. The ALCO is one. Typically in financial institutions, the ALCO is monthly. And I think Sati also mentioned the fact that it's risk, it's treasury, it's finance, and the business, they all come together. Again, that needs to be a very vigorous and robust activity. It's not just to come and listen to reports and go back to business as usual. And we need to know also when we need to increase the level of the frequency of the meetings if need be. There are times when you, and I know in many financial institutions, there are times when you know you need to have daily alcos, and you have daily alcos until the critical issue is resolved, and then you go back to normalcy. But let's not be too comfortable with normalcy, because quite a lot is changing in our midst. If nothing at all, competition is getting smarter and smarter, and competition is getting more and more global as well. So there are opportunities in there and there are threats in there. We need to adequately position ourselves to benefit and not be on the wrong side of such such opportunities or threats. I had mentioned the funding and gapping. It's very important to know our imminent maturities. It's very critical that it's something that we need to be very, very clear about on a day-to-day basis, on a week-to-week basis, so that we can put the right assets or liabilities in place to meet those kind of the basic requirements. The issue also around the limits. We have to have our systems in place to immediately flag breaches in limits. Having to know that at the end of the month can be a dangerous thing, because every day is critical now. So, and that's why there is a need to move from analog to digital, so that everyone can at the same time know where limits are being breached and where evasive actions need to be taken. So basically, ILAP, I like what it's trying to do. I need to note the fact that Basel III is not yet implemented from a regulatory perspective in Nigeria. But my view is that as risk practitioners, there is nothing within ILAP that is really strange to us. It's just trying to put a lot of things together in a particular structured manner for greater effectiveness. So my advice to all of my fellow risk managers is to get familiar with ILAP, start using or start putting in place some of its requirements, because even if it's not yet a regulation, it still doesn't debar us from benefiting from what it's trying to teach us, what it is trying to call our attention to, what it is trying to help us to become more aware and adaptive to. So let's all get familiar with it. Let's all start to use certain aspects of it, even in our day-to-day business, so that by the time it becomes regulation, we'll be more than ready, even supportive to the regulator to fully have it functional. I think for me, those are the critical things I'd like to touch on today. It's important that we realize that we are in a very volatile, very fast-changing universe, and we are competing not only within Nigeria, but across the world. Some of us are in international banks, some of us are in regional banks, some of us are in local banks, but I assure you, competition is global. Internally, you may operate as a local or regional or international bank, but in actual fact, we all compete in a global environment, and we need to have that understanding that there are banks in far-flung places that are willing to take our business away from us, that will put our banks in difficult situations, and it's our duty and our responsibility as risk managers to ensure that we navigate our various institutions safely and profitably, so that when we hand over to the next generation also, there will be something to run with, both from an industry perspective and the Nigeria economic perspective as well. So that's what I'd like to say today. I'd like to thank you all for listening, and thanks to my fellow panelists also. Thank you very much indeed.
Thanks for
Thank you so much,
Mr.
Sabir. Oh, sorry.
Yes, Pratik, please go ahead.
Yeah, so thank you so much. I think we have a number of questions lined up for Satya and Mr. B today. So I think Satya, if you can take on with the questions. Before that, if you go there, I just like to ask one more question that was asked on the chat window. Was specifically for Satya. He, during the presentation, you mentioned about decay profiles. If you could please throw a light on that.
Yeah. So decay profiles, that's in the context of understanding the core non-core aspect of non-maturing deposits. So as you know, as everyone understands, non-maturing deposits by definition do not have any maturity. So their cash flow, the outflow profile is more from a long-term perspective rather than what happens on a regular basis, because current and savings accounts on a regular basis, there are no restrictions from the bank side. The customers are able to withdraw whatever amount that they require from these accounts. But it is also important to understand that there are continuous inflows as well as outflows in each account. So it's not that there's only outflow, because as long as an account is maintained, there will be inflows and outflows, and thereby at any point in time, you can expect certain average or minimum level of balance to be there. And add to that, for example, if you take retail accounts, usually the number of accounts is very large for any given bank, despite the balance in each account being small. So when you have the advantage of diversifying, the accounts, within a retail current account portfolio or a retail savings account portfolio, because not everyone will want to withdraw their money at one time, unless there is a stress situation for which there are all these tools that need to be in place. But from a regular analysis perspective, you will see that while some segments of your accounts put in cash, some other segments withdraw cash. But if you look at it from a long-term perspective, you will see that there are certain trends on a very long-term basis, that certain cohorts of accounts, you will see that they are gradually decaying. So that means accounts belonging to retired people, accounts belonging to people who have been with the bank for a long time, but now are moving away, either because they have migrated or they've stopped interacting with the bank. So for a number of reasons, there could be people who are gradually stopping to interact and maintain their accounts with the bank. So the idea here is to understand that decay profile in the balances. So, and that can only be understood by looking at historical daily or monthly changes in the levels of balances at a cohort level. And obviously you should not be looking at it at the entire current account book level. Neither should it be at an individual account level, because individual account level will be quite volatile. And at the same time, looking at your entire portfolio level also will not give you any significant information as to what's happening within the accounts. So there you need to form homogeneous portfolios. Homogeneous portfolios are group of customers who are expected to behave similarly in similar circumstances. So for example, retail customers who are of certain age, employed in certain segment, and belonging to certain geography, for example. So these people could expect to behave in certain way given certain changes in the market. So first there needs to be analysis to identify those cohorts, and then once you identify, you can look at the long-term changes in the balances. And of course the important aspect here is while you derive the long-term decay profile, what will also be clear is during times of stress, when a large number of more number of people withdraw compared to the number of people who are depositing, and thereby you'll see a spike in the decay profiles. So that is where you can get a sense of what kind of spikes or increase in decays you might witness during times of stress, and how then you can plan for such future spikes in decay profiles, and how you can manage those outflows. I hope that answered the question. So let's quickly look at the other questions also. Um, from a trading liquidity risk, as it relates to market volatility risk, what type of scenarios could be considered for liquidity stress testing? From a trading liquidity risk, the risk primarily comes out of the volatility prevailing in the markets at various asset class for various asset classes. A significant portion of it comes from the investment book that you're holding, which is supposed to be liquid. So there are certain regulations in place. For example, you would obviously invest in government bills, T-bills, or government securities, central bank issued securities, which are expected to stay liquid. But again, there's a finer line, given the nature of the jurisdiction, whether you are a local player or you are investing in the securities of a different sovereign. So those are aspects that need to be taken into account. And in terms of scenario definition, you need to be looking at historical scenarios. For example, I can probably also club this with question to another answer to another question in terms of what kind of historical scenarios can be considered. I mean, there are some obvious ready examples for this kind of analysis, starting with the 2008 global financial crisis, where initially most of the markets globally dried up. And if you look for data for your bank, or if market data is available, you'd clearly be able to see what kind of haircuts, what kind of pricing spreads, how the credit spreads, how the interest rate basis points increased. There is a whole lot of information available in terms of the pricing spreads, in terms of haircuts, in terms of trading volumes that are possible during such stress. A few other examples would include looking at the 2016 oil price crash, when the oil price crashed to $30. So a number of economies where oil played a significant role. You would have seen that there within 1 to 2 months of that oil price crash happening, you would see that the ripples of that crash happening within the financial markets, where there would be a spike in the funding spreads, reduction in the availability of liquidity in the market, and increased haircuts because of demand for repos and short-term funding secured by such liquid securities. So, and then of course the recent COVID-19, at least the initial portion, initial few weeks of COVID-19, when geographies started to lock down their economies. Probably after a bit, most of the economies realigned, and central banks supported in a big way to maintain liquidity. But the initial realignment period will give a clue in terms of what kind of shocks can be expected. So essentially, as I mentioned, funding from a funding perspective, ability to roll over institutional depositors or wholesale deposits, haircuts applicable on your liquid securities, ability to roll over foreign currency transactions. For example, the forward points may change when you try to hedge your foreign currency, or maybe foreign currency markets may completely dry down, and the spreads may forward point spreads may spike, impacting your ability to roll over foreign currencies. So these are some aspects, when doing stress testing in terms of pricing spreads, haircuts, you could consider. And from a development finance institute, how could a development finance institute carry out ILAP, while it does not have trading book, and also what are the essential indicators to monitor? I mean, for any bank, we beat a universal bank, a wholesale bank, or a development bank, the key objective of ILAP is to understand the nature of your funding and understand the nature of the cash inflows and outflows that could happen during the times of stress. So I would not be completely aware of the specifics of this particular the background of this particular question. But from our experience, the types of risks are similar. I mean, delinquencies will increase, haircuts on your investment book will increase, and on the funding side, usually development institutes are backed by sovereigns or any international organizations, and maybe some part of funding may be coming from wholesale markets. So the part that comes from wholesale markets may also be impacted. So these are some areas that you can look into. Maybe be please feel free to add at any point in time. You're on mute, sir.
Yes, just to say that I agree entirely with you on that. Every institution, every financial institution has an asset side and a liability side, and so you will always have your assets to fund. From a development bank perspective, maybe what you do is to grant development loans to other financial institutions or to I don't know, government infrastructure development type agencies as well. So it means that you have to ensure that you have the liquidity and the funding to continue to support that. So the adequacy of that, the matching nature of your funds to the assets that you create also requires that you adequately manage your liquidity. You have your funding sources as well. You want to ensure that they are in place. You want to ensure that that's your various liquidity cushions are in place. If you take or grant loans in currencies other than your local currency, also there are matches in there that you have to ensure are in place. So quite frankly, DFI is as requiring of ILAP as any other financial institution, I would say. Thank you.
Going forward to a few other questions. Will there be additional capital charge requirements for liquidity risk as part of Pillar 2 risk assessment? Well, historically, while that has been the case, a number of regulators are moving away from the concept of charging capital in lieu of liquidity risk, because essentially these two are very different beasts. While capital ensures the long-term survivability and loss absorption of the institution, liquidity is a very short-term phenomena. And as B earlier mentioned, if liquidity stops today, then banks will fail immediately. So from a liquidity risk perspective, regulators are moving away from capital charge in lieu of liquidity risk. And what instead they are focusing on more Pillar 2 risk assessment from ILAP, imposing stress testing requirements, and ensuring that the level of HQLA is higher than what the banks are currently holding. So rather than ensuring that additional capital is held, they will ensure that additional HQLA will be held. And probably the other question in terms of the role of risk manager, like the CRO, what role should he have in ALCO? Whether should he be a approving member in ALCO, given that in credit committee usually he is forbid from being an approving member, given that he will be responsible for monitoring and managing that risk going forward. Maybe B, if you want to come in on this.
Yes, my view first and foremost is that it depends on how the institution is structured and the responsibilities that it has given to its chief risk officer. For instance, you have a chief risk officer who is also the reporting, is also the supervisor, as it were, of the head of credit. At a certain level, you are called to be a general manager, so to speak, and you should be able to have a balanced view that does not impede your ability to be independent. So I personally don't have any misgivings to a risk officer or a chief risk officer being an approving member of ALCO. He needs to bring on board his perspective, and he should be able to understand the perspective of the other major segments of ALCO as well. What we need in ALCO is balance, but balance in our overall judgment, in our ability to move our business forward safely. So whichever aspect of the bank's business that you are responsible for, it's that collaborative that is the chief expectation from any management committee. So everybody comes in there, you give your view, you give your perspective, you understand the other person's perspective, so that you deliver a decision that takes care of most of the concerns of everyone in the bank. The same thing with even in the area of asset creation. We are not at a certain level as risk managers, you are not just defending your turf. You're not a policeman, you're not a roadblocker or whatever term you may choose to use. You're an enabler for the bank to do business and be profitable in a consistent and reasonable manner. And that requires your ability to understand areas that are not necessarily your core area, but they are also important to the bank. So my view with that is that we should go out of our way to understand banking generally, to understand the economy across board, so that the value that we're adding will be one that is robust and will move our various institutions forward. So as risk managers, please go out there, go and understand finance, go and understand business, go and understand as much as you can understand. It only helps you to become better risk managers. Thank you.
Yeah, I totally agree with that, B. I mean, one thing many risk managers get accused of is that they while they do not have good understanding of the business, they are here to block a number of proposals put forward by business. So I think the points you made are highly relevant in that as a response. I think we have short more than 20 minutes from the planned time. I think Pratik, I think we can wrap up, and any questions and answered we can take them offline in the interest of time.
Yes, thank you so much, Satya. Thank you so much, Mr. B. I think we were able to answer a lot of questions, and and this is a topic that will never end if we just start discussing between risk managers. So respecting everyone's time, what we will do is the questions that were not answered, we have noted them down, and we'll have our panelists look at those questions and respond to them, and we'll share it with everyone who has joined us today in the session. And we'll also share link of the webinar, so people who face challenges listening to the webinar or were not able to join today, we'll share them the link to the webinar for them to sort of hear the panelists speak in the time of their availability. With this, I thank you, Satya and Mr. B, for your time today. And I also like to thank all the participants to join us for this webinar. Thank you so much. Have a nice day and stay safe. Thanks. Bye.
Thank you very much, everyone. Do have a good day. Thank you.
Thank you.